The world is a volatile place, geopolitical tensions simmer, economic uncertainty looms. Every day the news is filled with stories of conflict, trade wars, and political instability. These events create a sense of unease and unpredictability in the global markets. In times like these, investors often flock to safe haven assets like gold. Gold has been considered a reliable store of value for centuries, a hedge against the unknown. When the future seems uncertain, gold provides a sense of stability. Its price has surged recently, reflecting this global anxiety. The demand for gold has skyrocketed, pushing its value to new heights. Investors see it as a refuge from the chaos, a way to protect their wealth. Gold offers a sense of security, a tangible asset with intrinsic value, or so it seems. The allure of gold lies in its physical presence, something you can hold and store, unlike digital assets or paper money. The recent gold rush is understandable. People are looking for something solid, something that has stood the test of time. Gold has a long history of being a safe haven during turbulent periods. Inflation is eroding the value of fiat currencies. As central banks continue to print money, the purchasing power of traditional currencies diminishes. This drives more investors towards gold, seeking to preserve their wealth. Central banks are printing money at unprecedented rates. This monetary policy, aimed at stimulating economies, often leads to inflationary pressures. Gold, on the other hand, is seen as a hedge against inflation. Investors seek shelter from the storm, and gold seems to offer a port in the raging seas of financial uncertainty. The metal's historical performance during crises makes it an attractive option for those looking to safeguard their assets. But is gold truly the safe haven it's purported to be? While it has a reputation for stability, its price can be volatile. The question remains whether gold can consistently provide the security investors seek, or are we witnessing a bubble fueled by fear, ready to burst? The rush to gold might be driven more by panic than by rational investment strategies. Only time will tell if this golden refuge is as safe as it seems. The technical indicators paint a concerning picture for gold. Analysts are closely watching the market, noting that the recent trends could signal a significant shift. Its price has risen sharply, entering overbought territory. This rapid increase has caught the attention of both seasoned investors and market newcomers. The Relative Strength Index, a momentum oscillator, flashes warning signs. This tool is crucial for traders to understand the potential for price reversals. An RSI above 70 suggests an asset is overbought, while an RSI below 30 indicates oversold conditions. These levels help investors gauge market sentiment and potential turning points. Gold's RSI currently sits at elevated levels, hinting at a potential correction on the horizon. This could mean that the current bullish trend might not be sustainable in the long run. Is this recent surge in gold's price sustainable? Or is it driven by speculative fervor, detached from its fundamental value? The market's behavior often reflects a mix of rational analysis and emotional reactions. While gold has historically served as a hedge against inflation, its recent performance raises red flags. The disconnect between gold's price and its intrinsic value could lead to volatility. Investors should proceed with caution, carefully considering the risks before jumping on the gold bandwagon. It's essential to balance the allure of potential gains with the reality of market risks. Investing in gold is not as simple or secure as it may appear. Physical gold, while tangible, comes with its own set of challenges. Storage costs, security concerns, and the illiquidity of physical assets all pose significant hurdles. Paper gold, in the form of ETFs or futures contracts, offers an alternative. However, these instruments come with their own risks. Counterparty risk, where the issuer of the ETF or contract may default, can lead to substantial losses. Moreover, paper gold lacks the tangible nature of its physical counterpart, potentially eroding its appeal as a safe haven asset during times of crisis. Enter Bitcoin, a decentralized digital currency often dubbed digital gold. Like gold, Bitcoin possesses key characteristics that make it attractive as a store of value. It is scarce, with a limited supply of 21 million coins. It is secure, protected by a robust cryptographic network, and it is easily transferable, unlike physical gold. Unlike gold, Bitcoin is not tied to any government or central bank. Its value is determined solely by market forces, making it a truly global and a political asset. In a world increasingly defined by digitalization and decentralization, Bitcoin emerges as a compelling alternative to traditional safe haven assets like gold. A tale of two assets, comparing Bitcoin and gold. These two assets have captured the imagination of investors and enthusiasts alike, each offering unique characteristics and benefits. But how do they stack up against each other in various aspects? Let's compare these two assets side by side. We'll delve into their histories, their physical and digital properties, and their roles in the modern financial landscape. Gold has a long and storied history as a store of value, dating back thousands of years. It has been used in jewelry, coinage, and as a standard for currency systems. Its luster and rarity have made it a symbol of wealth and power throughout human civilization. Bitcoin, on the other hand, is a relative newcomer, launched just over a decade ago. Created by the mysterious Satoshi Nakamoto, Bitcoin introduced the world to the concept of decentralized digital currency, operating on a peer-to-peer network without the need for intermediaries. When we look at scarcity, gold has a limited supply, as it is a finite resource that must be mined from the earth. This scarcity has helped maintain its value over millennia. While Bitcoin has a fixed supply of 21 million coins, this predetermined cap is embedded in its code, ensuring that no more than this amount will ever exist, which many argue makes it a deflationary asset. In terms of durability, gold is resistant to damage, corrosion, and tarnish. It can withstand the test of time, which is why ancient gold artifacts are still found in excellent condition today, whereas Bitcoin is resistant to hacking and censorship. Its decentralized nature and cryptographic security make it incredibly difficult to tamper with, providing a robust defense against digital threats. Divisibility is another factor. Gold can be divided into smaller units, such as grams or ounces, but this process can be cumbersome and imprecise. But Bitcoin is highly divisible into satoshis, the smallest unit being 100 millionth of a Bitcoin. This high level of divisibility makes it suitable for microtransactions and everyday use. Portability is also key. Gold is difficult to transport, especially in large quantities. Its weight and bulk make it impractical for everyday transactions and international transfers. But Bitcoin is easily transferable electronically. With just a smartphone and an internet connection, Bitcoin can be sent anywhere in the world within minutes, making it highly convenient for global commerce. And when it comes to verifiability, gold is difficult to verify for authenticity, often requiring specialized equipment and expertise to ensure its purity and legitimacy. While Bitcoin is easily verifiable on the blockchain, every transaction is recorded on a public ledger, providing transparency and trust without the need for third-party verification. While gold may have the advantage of historical precedent, being a trusted store of value for centuries, Bitcoin offers distinct advantages in terms of portability, security, and verifiability. Its digital nature aligns with the needs of our increasingly digital world. As we move towards a more digital and interconnected world, the demand for a secure, efficient, and easily transferable store of value grows. Bitcoin's unique properties position it as a potentially superior store of value for the 21st century. Its ability to adapt to the digital age, combined with its fixed supply and robust security, make it a compelling alternative to traditional assets like gold. The future of finance is being shaped by three key forces: scarcity, security, and accessibility. Bitcoin, with its fixed supply, robust cryptography, and global accessibility, aligns perfectly with these trends. Gold, while scarce, suffers from limitations in terms of security and portability. In an increasingly uncertain world, investors seek assets that can preserve their wealth across borders and time. Bitcoin, with its decentralized nature and immutable ledger, offers a level of security and transparency unmatched by traditional assets like gold. The financial world is taking notice of Bitcoin's potential. Prominent investors, analysts, and institutions are warming to the idea of digital gold. Ray Dalio, founder of Bridgewater Associates, recently acknowledged Bitcoin's potential as an alternative gold-like asset. JP Morgan Chase, once skeptical of Bitcoin, now sees it as a competing asset class to gold. This growing acceptance by mainstream finance suggests that Bitcoin is no longer a fringe asset, but a serious contender for a place in diversified investment portfolios. Investing in Bitcoin, like any investment, comes with risks. Its price is volatile, subject to significant fluctuations. However, this volatility is often a sign of its nascent stage and rapid growth potential. As Bitcoin matures and its adoption widens, its price is expected to stabilize. The potential rewards of investing in Bitcoin are significant. Its limited supply, coupled with increasing demand, could lead to substantial price appreciation in the coming years. For investors willing to embrace a calculated risk, Bitcoin offers an opportunity to participate in the early stages of a potentially transformative technology. The world is changing. The financial landscape is evolving. Traditional safe haven assets like gold may no longer be the best way to preserve wealth in the 21st century. Bitcoin, with its digital nature, decentralized structure, and limited supply, offers a compelling alternative. While past performance is not indicative of future results, Bitcoin's historical returns have far outpaced those of gold. As more investors recognize its potential, Bitcoin's position as a leading store of value is likely to strengthen. This is not merely about investing in an asset, it's about embracing the future of finance.